Right now, there is a very simple story being told about inflation. You've probably heard it. The cost of living is being driven up by overseas geopolitical conflicts and strained supply chains. It's an easy narrative to accept because a sudden shock over there causes an immediate ripple effect over here. This chart tracks the PCE metric, the Fed's official scorecard, aiming for a strict 2% target. That target hasn't been met in 63 months. Aim for 0 and they're out of ammunition during a recession. Push to 4% and living costs double. That single data point dictates every financial decision you make. Your mortgage rate, your car loan, what your savings account pays, and exactly what the cash in your wallet will be worth next year are all priced off what the market expects that target number to be. Which brings us back to the problem with the mainstream story. The geopolitical conflicts making recent headlines started just a few months ago. Yet everyone is using those recent events to diagnose a chronic 5-year-old failure to hit the target. The truth is, the primary mechanism the Fed uses to control the cost of living isn't working the way it used to. The pendulum has essentially snapped in half. We are misdiagnosing the economic crisis because the main mechanism meant to fix it is actively starting to make it worse. To understand why that mechanism is breaking today, we have to look at the last time it was successfully pushed to its limit. In 1979, inflation was sprinting past 13%. Paul Volcker took over as Fed chair and did the one thing nobody else had the stomach for. He drove interest rates up to 20%. By jacking up the cost to borrow, he slammed the mechanical brakes on the economy. He deliberately choked off the money supply, triggered back-to-back recessions, and starved inflation down to under 2%. When Volcker raised rates, the national debt was only a quarter the size of the total economy. At that scale, the government could absorb the interest bill without it devouring the federal budget or forcing the Treasury to borrow massive amounts just to pay what it already owed. Because the government's debt load was so light, the country could absorb the damage of those massive rate hikes. The lever did exactly one thing. It slowed down consumer and business borrowing to cool off the economy. But compare that to today. This expanded block shows our current national debt, which is sitting at roughly 100% of GDP. The debt is now a 1-to-1 match with the entire American economy, a level we haven't seen since the Second World War. That massive size creates a severe mechanical problem. When the Fed raises rates now, it presses down in two different places. It still hits the brakes on consumer borrowing, making your car loan and mortgage more expensive. But simultaneously, it steps heavily on the accelerator for the federal government. Higher interest rates mean the government has to pay significantly more to service the trillions of dollars it already owes. That annual interest bill is now running at around $1 trillion a year. That is more than the entire U.S. military budget. Those interest payments don't just vanish into the ether. Every time the Fed writes a larger check, those billions of dollars land straight in the accounts of bondholders, foreign governments, pension funds, and private investors. This flowchart tracks exactly where that capital goes next. The investors take that massive government payout and immediately turn around and spend it, lend it out to businesses, or roll it into the next high-yielding bond. So the very action meant to pull money out of the system ends up quietly pumping $1 trillion right back into it. At these extreme debt levels, one foot stomps the brake while the other automatically pushes the gas. When you see headlines celebrating that inflation is cooling down, they are usually pointing at lagging indicators, like housing. Rents lock in for a year and only reset in steps. Those optimistic numbers are just measuring economic pressure that was released months ago, not what is happening right now. To see what is happening today, look at this chart tracking the M2 money supply. This measures the volume of cash sloshing around the system. After the massive, near-vertical spike in 2020, the M2 supply is once again growing at over 5% a year. Between 2022 and late 2023, the Fed successfully drained over $2 trillion out of the economy. But a modern economy requires a massive level of baseline liquidity to settle daily transactions and keep banks functioning. By December, the Fed realized they had hit that floor, leading Jerome Powell to pivot and start buying bonds again, pumping $40 billion a month back into the system to keep it alive. Two economists, Thomas Sargent and Neil Wallace, predicted this trap in 1981. They argued that if a government never runs a surplus, the Fed can't actually make the debt smaller. It only gets to choose what form that debt takes, bonds or cash. By choosing bonds and high rates today, the Fed builds a larger pile of interest-bearing debt that eventually forces them to print more cash later to cover the bill. The core driver of that deficit is deeply structural. Our political incentive system points in one direction. Politicians build careers and win elections by promising to spend more money. No one wins a campaign by promising the public less, which is why Warren Buffett once suggested a very direct fix for this incentive structure. He said, "You just pass a law that says that any time there's a deficit of more than 3% of GDP, all sitting members of Congress are ineligible for re-election." He was joking, but the underlying warning is completely serious. We have been spending more than we bring in for a quarter of a century straight. The more we borrow, the more interest we owe. The more interest we owe, the more we have to borrow. It is a loop that compounds on itself, and every single year we put off fixing it, the inevitable correction gets significantly worse.